Hello, this is Sylvia of CPDbox.com. Welcome to this video with my answer to one of your questions. Today's question comes from Tunde from Nigeria, and let me read it. Our company policy is to pay 2% of the net profit to our employees who worked for us during the full previous year from 1st January to 31st December. We booked the dividends for 2019 as a profit distribution in 2020 when they were approved by our shareholders. But our auditors say this is wrong and we should book it as an expense in profit or loss in 2019. Can you please explain why and clarify? This is a very common question and common belief that anything called dividend is automatically accounted for as a distribution of profit. Well, let me tell you that a true distribution of profit is a transaction with equity holders or with shareholders. So the principal question here is, are your employees also the shareholders? Are the dividends paid out to them in their capacity of shareholders? Or are the dividends paid out in return for their service for the company? Well, if the dividend is paid out to the employees being the shareholders, then yes, you are right. Well, this can normally happen that employees hold also some shares, and if they receive the dividend based on the number of shares they hold, then yes, this is recognized as a distribution of profit. But if the dividends paid out are a part of some remuneration scheme, then no, this is not a distribution of profit reported in the statement of changes in equity. This is a typical profit-sharing plan, and it falls under the standard IAS 19 employee benefits. So what does the standard IAS 19 say about the profit sharing? You should recognize the expected cost of profit sharing only when two conditions are met. Number one, there is a present legal or constructive obligation to make such payments as a result of past events. And number two, a reliable estimate of the obligation can be made. So if you promised in the employment contract to pay out the so-called dividend to employees, or there's some trade union treaty, or even employees expect that because that's your long-term practice, then there's a present obligation. And the estimate can be made almost always in this case. So therefore, when you make your closing of the year end, you have to calculate the amount of profit sharing and book it as debit expense, credit liability in that period, and not in the subsequent period after it is approved by the shareholders, and not as a distribution of profit via statement of changes in equity. Here I'd like to point out one trouble I see with the profit sharing. Some employment contracts say that the employee is entitled for profit sharing only if he or she stays with the company for some time after the end of the relevant year. So let's say that the financial year end is on 30th June, but the employees will get the profit share only if they stay for the full calendar year. There's no clear guidance on how to treat this issue, and there are basically two basic ways of how to deal with that. So the first approach, you should recognize the cost of the profit sharing not only in the year in which it is earned, but over a longer period until the employee has the right to receive it, because the employee would get nothing if he leaves earlier. Or the second approach, you would recognize the full profit sharing in the year when it is earned, because the amount of benefit does not increase after the 30th June or after the year end. I like the first approach more than the second one because this way you don't overstate your expenses in the first year. But maybe both approaches would be acceptable. I've seen both in the practice. The last point. In some countries, there are statutory employee benefit schemes where employers are required by the laws or legislation to pay certain percentage of profit after tax to the employees. This type of bonuses also falls under IAS 19 and should be accounted in the same way I have just described, because in substance it is still provided in return for the employee's service or work. So just don't apply IAS 12 income taxes or IAS 37 provisions. You should follow IAS 19. So that's it for today. The information in this video is not a substitute from a professional judgment of CPA of your own situation and circumstances, and you should consult CPA or other qualified professional. If you want to ask your own question, please send it via contact form on my website, and I will make a video like this one. Thank you very much for watching. Please sign up for my channel if you liked it, share this video with your friends and colleagues, and stay tuned. Bye!